This is Bazaar Morning Call, broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV18 Motilal Oswal studios. It's the post-Fed day, so there's a lot to discuss, lots to talk about. The big event risk was this one, and it's passed, and dare I say, in a very peaceful, smooth kind of a way. I'm Prashant Nair, with me, my colleague Sonia and Nigel. Guys, hi, morning.
Hi, good morning, Prashant. Good morning, Nigel. And as they say, right, no news is good news. So there was no major news from the Fed, which means that it could be good news. And that's what the street is also looking at. Looks like it's going to be a good start to trade.
Well, and let's keep an eye out on volumes. They've been quite tepid in the last few days. We've got a longer weekend that comes up. So let's see whether or not we see some pickup post this big event that's out of the way.
Let's just quickly tell our viewers what they need to know as they begin another session, right? So the message from the Fed was absolutely clear. It was straightforward. And in a straightforward way, it was dovish. And I think that is important. They basically are saying that inflation is stronger, but stronger inflation, not just what they've seen, which is January and February, but further future stronger inflation than expected will not stop rate cuts. I think that is as clear as it gets. Now, FOMC, and this was the fear, right? There was, of course, no change in rates or anything. Nothing was expected. But the fear was that because of higher inflation in January and February, and persistence of inflation, the Fed in their projections, what is called the dot plot, could say we'll not see 3 rate cuts, but we'll see 2 in 2024. No change. They are still seeing, the dots still show that there are 3 rate cuts, a total of 75, 25 each, 75 basis points, which the Fed itself is saying they will see, or they expect to see in 2024. Just one comment which I think stood out, and again, this talks to essentially the inflation print. January and February numbers were hot, and he essentially described them as, and I quote, bumps in the road in the disinflation process, which is inevitable. And I think that put the market's mind at ease that even in the future, if inflation comes a little hot, it's not going to be that big a problem, unless, of course, it's a really ugly number. Markets themselves, so the Fed is saying 75 basis points if you look at the dots. The market, the swap pricing is now indicating an 82 basis point cut for the full year 2024. So that is 82. The first cut is expected in June by everyone. For the May meeting, there is only 3 basis points which is priced in. Right, in terms of rate cuts, market pricing, 3 basis points priced in. And some are saying, well, who knows, maybe we'll see something in May. And the market needs to price that up a little bit. So, I think all that will pan out over the next few days and few weeks, so as to speak. Now, you've got basically the equity indices, which were up. So, the S&P 500, which was up about 0.9%. The Nasdaq was up about 1.25% as well. The 10-year lost about 1 basis points. We ended at about 4.2%. 2.8%, not very different, right? Nothing large in that sense. And it's kind of held on to gains. As it often happens that, day 2, day 3, etc. are more important once the market fully digests what's happened. Dollar index, though, was a more pronounced reaction. It ended about 1/3% lower to about 103.24. Oil is seen a bit of a pullback. I would say it's more technical rather than fundamental. There was no news flow, but it fell about 1.5%. There was the April WTI expiry as well, and maybe that at the margin had an impact. So more technical in that sense. 86 is where oil is. It was heading, it was above 87 at the same time yesterday. Now to kind of circle back and tie in the levels. Yesterday was an absolutely flat close, but if you only were watching the market at 3:30 or later in the day, you would kind of miss out the incredible volatility that we had through the course of the day. 300-400 point swings up and down, at least in the Nifty Bank. Actually in percentage terms, we saw 1.5% moves twice over in the course of a single trading session. And by close, it was nothing, absolutely flat. For the Nifty, and I was saying this yesterday as well, short-term indicators, there are many short-term indicators which are pointing to a bounce. I would still kind of say that a bounce is due. It's lurking around the corner. The Nifty needs to take out, these are all hourly averages. The first two are hourly averages. 21,904 and 21,985. These are the 20 and the 40 hourly averages. And then the 61.8% of the fall is 22,214. You need to get past these levels. Then we'll start to talk about higher levels. It will give confidence for bulls to come back. And of course, the recent low is 21,710. That should not be broken on the way down. Bank Nifty saw a close which down for the 9th straight session. Again, here There is a retracement which is due. The resistance there is the 40 hourly average, which is 46,600. We left off at about 46,300 or so. I think the picture has gotten a little clearer from the global perspective, really speaking. But, the issues here in India have largely been centered around, the broader market, small caps, etc. But I think it gives us a good pathway, good visibility that they're not going to be nasty surprises from a policy action perspective, especially from the Fed and other central banks. 170 points higher on the GIFT Nifty. I mean, it's indicating a big gap up. Sonia.
Oh, absolutely, a big gap up. And, the sell-on rally that we were talking about last few days, that will be tested today, right? Yeah. Because that was the narrative of the market in the last many days, that this market is now turned from buy on dips to sell on rally. But that will be pretty much tested today. So it's going to be a very interesting day of trade. As you said, the GIFT Nifty is suggesting a big opening. Now, the US markets had a very strong rally after everything was maintained. The Fed maintained rates, did not move on rates. Also, the Fed reiterated their expectations of 3 rate cuts this year. The Dow was up 400 points at a fresh record high. Not just that, the Japanese market is at a fresh record high as well. It it rallied substantially overnight. So the going has been good. The Fed not only reiterated expectations of 3 rate cuts this year, they also raised their GDP expectations for the full year to 2.1%. So a lot of positives came through from the meeting yesterday. The Nifty has been holding on to the 21,800 level. There was large selling by foreign investors yesterday. FIs sold about 2,600 crores in the cash markets, while DIIs, they bought 2,600 crores in the cash markets yesterday. So it was kind of even Stevens yesterday. The fall in crude is a sentiment positive for a lot of sectors like OMCs, etc., tire companies. So just keep an eye out on some of these names. Brent slipped below that $87 a barrel mark, and gold has been moving up higher. So that is one asset class that continues to do very well. But this morning, with Wall Street indices at lifetime highs, with our own markets, not too bad, holding on to 21,800. Looks like the going is good, but let's see, it has been a sell-on rally market. Does that theory get tested today? We'll find out.
Well, yesterday, in fact, it turned into a buy on dips, right?
Yeah.
Because some of those technical indicators, they did get stretched. But let's highlight the 3 broad points that we're looking at today. The Nifty Bank, that's been a relative underperformer, and that's been correcting for the last few sessions. So can it give up its underperformance? Can it break its losing streak? Point number 1. Point number 2 is the Nasdaq and various IT-related stocks did well overnight. So can it have a bit of a rub-off on the IT pack, and can the IT pack participate? If both those 2 cues go in favor of the bulls, then the Nifty is set to move ahead and break that 21,950 odd mark. The GIFT Nifty suggesting that we start above those levels. We'll need to build onto that mark as well. For the time being, in fact, yesterday we did see a good recovery from around the 21,700 odd mark. The cash market volumes, we've been mentioning this, they are absolutely very, very tepid in comparison to the averages. So if you look at it, the last 3 sessions, you've only seen around 80,000 crores, approximately 80 lakh approximately. And in fact, on an average, it's much higher. So the volumes have been nearly around 20% lower than what we normally see. The net short positions, that as well has moved up drastically. So from around 30,000 short contracts, that moved up to around 60,000. And yesterday there was an addition of close to around 10,000 contracts on the net short side from the FIS table. When that number gets to around 100,000 out, sometimes you see a very big bounce. Part of that did take place yesterday when it reached close to around 85,000 contracts. So net short market, that could be the reason that we see a bit of a bounce. The Nifty Bank, that's seen a correction. Last 9 sessions, down close to around 1,700 points odd. Yesterday as well, it showed signs that it doesn't want to go ahead and break that 46,000 odd mark. And that's going to be a crucial support zone. So to pull up the support zone, yesterday's low, 45,830, and the 100 DMA, that becomes very, very crucial on the downside. On the upside, though, is for starters, you'll want it to trade above the 50 DMA. That's been elusive as well. So you want to get and make a dash towards the 20 DMA. And similar is the case on the Nifty as well. The 20 DMA is the crucial mark. But for the time being, going by this start that we like to see, you'll want to see some build on there. And the PCR yesterday went to an oversold level. Intraday it went to around 0.7. Now, because of the kind of options data that we saw, it's got back to around a 0.8 odd. So let's get to the Nifty levels then. Yesterday's low, that's important on the downside. The 50 DMA, we in all probability, we start a little above this mark, and then you want it to dash towards the 20 DMA. So the Nifty Bank holds the key today. It's been an underperformer. Can it break that losing streak? That's going to be the trigger for the Nifty to get past that 21,950 odd mark.
All right, Nigel, thanks very much for that. Well, that's the setup as we see it. Before we go any further, let's quickly tell you what's lined up here in the first half hour of the show today. We'll get you updates from markets across the globe. Peter Cardillo, Chief Economist at Spartan Capital Securities, will join in for some quick views. Our research team gets us the top stocks for the day, the 10 top names. At 8:30, we get Deepan Mehta, Director, Elixir Equities, for a fundamental check on things.
All right, on the equities, we have Eric Fishwick of CLSA, who says that the Fed left rates unchanged at its March policy meeting. He says this was a given. The scrutiny was always on the guidance from the press conference and Fed's projection materials, which showed that the FOMC comprises of fewer doves than it did in December. But the central tendency forecast remains that the Fed funds rate will be cut 3 times this year for a December Fed funds ceiling rate of 4.75%. He says the Fed's guidance suggests that it is looking at a further 3 cuts in 2025, with the ceiling rate being 4% at 2025 end.
Parul Mittal Sinha of StanC weighs in on the forex market. She says that the USD INR has moved higher, driven by stronger dollar and unwinding of carry positions. She says limited participation from local banks has led to a weaker INR. She goes on to say that given the balanced statement from the FOMC and the June rate cut expectations intact, she expects the dollar INR pair to trade between around 83 to 83.3 to the dollar in the near term.
Okay, and on the bonds, Parul says domestic bond yields overnight continue to trade closer to the repo rate on RBI's active liquidity management through VRS. She says while lower US yields are likely to have a salutary impact, concerns of yet another upside surprise on SDL supply is likely to keep the 10-year benchmark bond yield in a range of 7.05 to 7.15% in the near term.
Okay.
Well, we have a lot of stock-specific action to track for you. We get to that in just a bit in our special top 10 segment. For the time being, we just run you through the list. TVS Motors, Wockhardt, RVNL, Infra, Prince Pipes, Crompton, PB Fintech, Hinduja Global, Saxkin Technologies, as well as ASM Technologies. All of them will be reacting to positive news flow, and it's that sort of a day. So we're expecting most of these stocks to react in the green.